Hello, and welcome back to Boni's Life, your weekly deep dive into the forces shaping our financial world. I'm Boni, and I'm thrilled to have you with me as we navigate the complex and often chaotic currents of the global markets. This week, we're tackling a beast of a topic: the intricate dance between geopolitics, macroeconomics, and the ever volatile crypto market. We'll explore how global power plays and economic shifts could send shockwaves through your portfolio, and most importantly, how you can prepare to ride those waves instead of being swept away by them. We'll also be looking at some key triggers to watch this weekend and outlining some strategies for the next 24 hours. So, grab your coffee, settle in, and let's get started. First, let's talk about the elephant in the room: the current geopolitical climate. As we step into 2026, the world stage is anything but calm. We're seeing a dramatic increase in what I like to call economic warfare. The Trump administration has been on a tariff rampage, increasing them more than sixfold in the last year alone. We're not just talking about a few percentage points here and there. We're looking at potential 200% tariffs on pharmaceuticals by the end of the year. This isn't just a trade spat, it's a fundamental reshaping of global trade dynamics. The ongoing tensions between the US and China, with reciprocal tariffs hovering around 30%, are creating a ripple effect across the globe, impacting everything from supply chains to consumer prices. But it's not all doom and gloom. Amidst the trade wars, new alliances are being forged. The recent US-Ecuador trade deal framework is a prime example of how countries are seeking to navigate this new landscape. We're also witnessing the expansion of the BRICS bloc, which now includes 10 members and 10 partners, creating a formidable economic force that is challenging the traditional Western-led order. This shift towards a multipolar world where multiple power centers vie for influence is creating both risks and opportunities for investors. The recent US military strike in Venezuela, a move some are calling Monroe Doctrine 2.0, has sent a clear signal that the US is reasserting its influence in its backyard, forcing countries like China to reassess their global investment strategies. Now, you might be thinking, Boni, this is all very interesting, but what does it have to do with my crypto portfolio? And that, my friends, is the million-dollar question, or given the current market, perhaps the $100,000 question. The truth is, in today's interconnected world, no market is an island. The geopolitical shifts we're seeing are creating a powerful undercurrent of uncertainty, and in times of uncertainty, investors flock to assets that are perceived as safe havens. Traditionally, that has meant gold, but increasingly, we're seeing a new contender for that title: Bitcoin. Let's look at the data. The total crypto market cap topped a staggering $4 trillion in July of last year, and Bitcoin itself hit an all-time high of over $126,000 in October. While we've seen some consolidation since then, with Bitcoin currently trading in the $90,000 to $91,000 range, the long-term trend is clear. Institutional investors are no longer just dipping their toes in the crypto waters. They're diving in headfirst. We're talking about over $200 billion in global assets now held in crypto ETFs and ETPs. And with the recent approval for the DTCC to provide tokenization services, we're on the cusp of seeing traditional finance move onto crypto rails in a big way. This brings me to the first of our 5 key crypto trends for 2026: further institutionalization. The days of crypto being a niche interest for tech enthusiasts are long gone. We're seeing Bitcoin ETFs being included in 401ks, model portfolios, and directed mandates. This means that the price of Bitcoin is becoming increasingly driven by global macro sentiment, rather than just the whims of a small group of crypto-native investors. As Ophelia Snyder, co-founder of 21 Shares, puts it, what people often miss is that this is where most of the actual money is, and a few haven't even begun to really actually allocate. Our second trend is accelerated tokenization. While tokenized assets still represent a tiny fraction of the global equity and bond markets, the momentum is building. The ability to represent real-world assets like stocks, bonds, and real estate on a blockchain opens up a world of possibilities for increased liquidity, fractional ownership, and 24/7 trading. As Alex Thorne of Galaxy Digital predicts, we're likely to see the early stages of formal rulemaking for tokenized securities in the second half of this year. Next up, we have stablecoin infrastructure development. The stablecoin market has exploded in the past year, growing from $206 billion to over $300 billion. The passage of the Genius Act has provided a much-needed regulatory framework for stablecoins, attracting major players like Stripe, Fiserv, and Klarna to the space. The next big challenge, as Juan Lopez of Van Eck Ventures points out, is creating a seamless and secure infrastructure for routing payments across different platforms and blockchains. Our fourth trend is the emergence of markets for everything. One of the most powerful features of crypto is its ability to create always-on global markets for any asset. We're already seeing this with the rise of perpetual futures platforms like Hyperliquid, which traded nearly $3 trillion in 2025. These markets are now extending beyond crypto to include traditional assets like oil, interest rates, and even Fed rate decisions. This is a game changer for traders, allowing them to hedge, speculate, and express their macro views in ways that were never before possible. And finally, our fifth and perhaps most futuristic trend is the intersection of crypto and AI. As artificial intelligence becomes more autonomous, it will need a way to move money on its own. This is where crypto comes in. The ability to conduct microtransactions for a fraction of a cent makes blockchain the ideal platform for the emerging machine-to-machine economy. As Coinbase Ventures' Huli Tejwani says, there's going to be a massive machine-to-machine economy. Doing a lot of that activity on blockchains is very logical. Now, I know I've thrown a lot of information at you, so let's bring in some other voices to help us make sense of it all. When it comes to the macro view, there are few minds sharper than Raoul Pal, the CEO of Real Vision. Raoul is predicting a 30 times growth for the crypto market by 2026, seeing the current $3.5 trillion market as just 3% of its $100 trillion potential. He's a big believer in the power of liquidity, and he sees the upcoming $10 trillion debt rollover in 2026 as a major catalyst for risk assets like crypto. As he puts it, the crypto cycle has extended to 2026 due to debt refinancing schedules, which will require significant liquidity. Then we have Michael Saylor, the unapologetic Bitcoin maximalist and CEO of MicroStrategy. Saylor has been on a Bitcoin buying spree with his company now holding over 673,000 BTC. He's not just talking the talk, he's walking the walk, and his conviction is a powerful signal to the market. And of course, we can't forget Cathie Wood of ARK Invest. While she recently lowered her 2030 Bitcoin price target from $1.5 million to $1.2 million, she remains incredibly bullish on the long-term potential of the asset. Even the old guard is starting to come around. Jamie Dimon, the CEO of JP Morgan, who once famously called Bitcoin a fraud, has softened his stance, now likening owning it to the right to smoke. And his bank is even considering offering crypto trading to its institutional clients. This is a seismic shift, and it's a clear indication that crypto is no longer an asset class that can be ignored. Now, let's add another layer to our analysis: historical parallels. History doesn't repeat itself, but it often rhymes. The current geopolitical and economic climate has echoes of past eras of global upheaval. Think of the early 20th century with its rising nationalism, trade protectionism, and the breakdown of the first era of globalization. Or the 1970s, with its oil shocks, stagflation, and the end of the Bretton Woods system. In each of these periods, we saw a flight to hard assets and a search for new stores of value. In the 1970s, it was gold that soared. Today, many believe that Bitcoin is poised to play a similar role. But there's a key difference this time around. The rise of Bitcoin and other cryptocurrencies is not just about a new asset class. It's about a new technology. The internet democratized information. Blockchain has the potential to democratize finance. This is a paradigm shift of epic proportions, and it's happening right before our eyes. The transition from a centralized to a decentralized financial system will not be smooth. There will be volatility, there will be regulatory battles, and there will be winners and losers. But the direction of travel is clear. Let's talk about the regulatory landscape, because that's a huge piece of the puzzle. For years, the crypto industry has been operating in a gray area, with regulators struggling to keep up with the pace of innovation. But that's starting to change. The appointment of Paul Atkins as the new SEC chairman has been a breath of fresh air for the industry. Atkins is a proponent of what he calls Project Crypto, a framework for regulating digital assets that is based on common sense and basic fairness. He's moving away from the regulation by enforcement approach of his predecessor Gary Gensler and towards a more collaborative and transparent process. One of the key pillars of Project Crypto is the development of a clear token taxonomy. This will provide much-needed clarity on which crypto assets are considered securities and which are not. This is a huge deal because it will remove a major source of uncertainty that has been holding back the industry for years. As Atkins himself has said, if the United States insists on making every on-chain innovation run through a securities law minefield, those innovations will migrate to jurisdictions that are more willing to distinguish among different kinds of assets and more willing to write down the rules in advance. And it's not just the SEC that's making moves. The passage of the GENIUS Act has created a clear regulatory framework for stablecoins, which are a critical component of the crypto ecosystem. This has already attracted major players like Stripe and Fiserv to the space, and it's a major step towards mainstream adoption. So, with all of this in mind, how should we be positioning ourselves for the weekend and the week ahead? Let's take a look at the charts. Bitcoin is currently in a tight range, with key support levels at $87,330, $88,000, and $89,600. On the upside, we're looking at resistance at $92,500, and then a major hurdle in the $94,000 to $94,645 range. A decisive break above that level could open the door to a run at the psychological $100,000 mark. However, a break below our support levels could see us retest the low $80,000. The trend signals are mixed right now, so this is a time for caution and careful planning. For Ethereum, the picture is a bit more bearish in the short term. It's currently testing support levels, and a break below could lead to further downside. However, the long-term fundamentals for Ethereum remain strong, with the ongoing development of its ecosystem and the growth of DeFi and NFTs. A smart strategy here might be to wait for a clear sign of a bottom before entering a new position. Now, for our 24-hour trading strategy. Given the current uncertainty, I would recommend a range-bound trading approach. Look for opportunities to buy at the lower end of the range and sell at the upper end. Keep your stop losses tight and don't get greedy. This is not the time for home run swings. It's a time for singles and doubles. And as always, do your own research and never invest more than you can afford to lose. Let's delve deeper into the technicals. For Bitcoin, the Relative Strength Index, RSI, is hovering around the 50 mark, indicating a neutral sentiment. The Moving Average Convergence Divergence, MACD, is showing a slight bearish crossover, but it's not yet confirmed. This suggests that we could see some more sideways price action before a decisive move in either direction. A key indicator to watch is the 200-day moving average, which is currently sitting at around $85,000. A break below this level would be a major bearish signal. For Ethereum, the RSI is in oversold territory, which could suggest a potential bounce in the short term. However, the MACD is still in a strong bearish trend. A key level to watch for Ethereum is the $3,000 mark. A break below this level could open the door to a move down to the $2,500 support level. On the upside, a break above the $3,500 resistance level would be a bullish signal. Beyond the technicals, there are a few fundamental triggers to watch this weekend. First, keep an eye on the news coming out of the G7 summit. Any major announcements on trade policy or global economic cooperation could have a significant impact on the markets. Second, watch for any new developments in the ongoing regulatory debate in the US. The SEC's Project Crypto is still in its early stages, and any new guidance or rule proposals could move the markets. Third, pay attention to the macroeconomic data releases, particularly the inflation numbers and the Fed's commentary on interest rates. Lower interest rates are generally supportive of risk assets like crypto, so any dovish signals from the Fed could be a positive catalyst. And that's a wrap for this week's episode of Boni's Life. I hope you found this deep dive into the world of geopolitics and crypto both informative and thought-provoking. The world is changing at a rapid pace, and it's more important than ever to stay informed and adaptable. Remember, knowledge is your most powerful tool in this market, so keep learning, keep questioning, and keep striving to be the best trader you can be. I'd love to hear your thoughts on this week's episode. What are your predictions for the crypto market in 2026? What are the key triggers you're watching this weekend? Let me know in the comments below, and if you found this video helpful, be sure to hit that like button, subscribe to the channel, and ring that notification bell so you never miss an episode. Before we wrap up, I want to take a moment to discuss some specific trading scenarios that could play out over the next few days. Understanding these scenarios will help you make better decisions and position yourself for success no matter which direction the market moves. Scenario 1. The bullish breakout. If Bitcoin manages to break decisively above the $94,645 resistance level with strong volume, we could see a rapid move towards the $100,000 psychological level. This scenario would likely be triggered by a combination of positive regulatory news, strong institutional buying, or a weakening US dollar. In this scenario, altcoins would likely follow Bitcoin's lead, with Ethereum potentially testing the $3,800 to $4,000 range. The key here is to watch for confirmation. Don't chase the breakout. Wait for a retest of the breakout level as support before entering new long positions. Set your stop loss just below the retest level to protect against a false breakout. Scenario 2. The bearish breakdown. On the flip side, if Bitcoin breaks below the 87,330 support level, we could see a move down to the 82,000 to 84,000 range. This scenario would likely be triggered by negative macroeconomic data, escalating geopolitical tensions, or a hawkish surprise from the Federal Reserve. In this scenario, it's important to preserve capital and avoid trying to catch a falling knife. Wait for signs of stabilization before re-entering the market. Look for bullish divergences on the RSI or a strong bounce off a key support level. Ethereum would likely fare worse in this scenario, potentially testing the $2,800 to $3,000 range. Scenario 3. The sideways grind. This is perhaps the most likely scenario in the short term. Bitcoin continues to trade within its current range, oscillating between $88,000 and $92,500. This scenario would be characterized by low volume and indecision in the market. In this case, a range trading strategy is your best bet. Buy near the lower end of the range and sell near the upper end. Use tight stop losses and take profits quickly. This is not the time for large position sizes. Focus on consistency and capital preservation. Now let's talk about risk management, because this is absolutely critical in the current environment. The crypto market is notoriously volatile, and even the most well-researched trades can go against you. That's why it's essential to have a solid risk management plan in place. First, never risk more than 1% to 2% of your total trading capital on a single trade. This ensures that even a string of losses won't wipe out your account. Second, always use stop losses. I can't stress this enough. A stop loss is your insurance policy against catastrophic losses. Third, diversify your portfolio. Don't put all your eggs in one basket. Spread your risk across multiple assets and strategies. Another important aspect of risk management is understanding your own psychology. Trading is as much a mental game as it is a technical one. Fear and greed are the two emotions that drive most trading mistakes. When the market is rallying, greed can cause you to hold on to positions for too long or take on too much risk. When the market is falling, fear can cause you to sell at the worst possible time or freeze up and fail to act. The key is to develop a trading plan and stick to it, regardless of how you're feeling in the moment. Write down your entry and exit criteria before you enter a trade, and don't deviate from the plan unless there's a clear and compelling reason to do so. Let's also talk about the role of liquidity in the crypto market. Liquidity is the lifeblood of any market, and it's particularly important in crypto. When liquidity is high, it's easy to enter and exit positions without significantly impacting the price. When liquidity is low, even small trades can cause large price swings. This is why it's important to trade during periods of high liquidity, typically during US and European trading hours. Avoid trading during weekends or holidays when liquidity tends to dry up, and be especially cautious when trading smaller altcoins, which often have much lower liquidity than Bitcoin or Ethereum. One of the most exciting developments in the crypto space right now is the growth of decentralized finance, or DeFi. DeFi platforms allow users to lend, borrow, trade, and earn interest on their crypto assets without the need for traditional financial intermediaries like banks. The total value locked in DeFi protocols has grown exponentially over the past few years, and it now stands at over $100 billion. This is a testament to the power of blockchain technology and the demand for more open and transparent financial systems. However, DeFi is not without its risks. Smart contract vulnerabilities, regulatory uncertainty, and the complexity of these platforms can all pose challenges for users. That's why it's important to do your due diligence before investing in any DeFi project. Read the white paper, understand the tokenomics, and assess the team's track record. Another area to watch is the development of central bank digital currencies, or CBDCs. Governments around the world are exploring the possibility of issuing their own digital currencies, and some have already launched pilot programs. The motivations for CBDCs vary, but they generally include improving payment efficiency, enhancing financial inclusion, and maintaining monetary sovereignty in the face of private cryptocurrencies. However, CBDCs also raise important questions about privacy, surveillance, and the role of central banks in the economy. As these projects move forward, they will undoubtedly have a significant impact on the broader crypto ecosystems. Let's not forget about the environmental concerns surrounding cryptocurrency mining, particularly Bitcoin. The energy consumption of the Bitcoin network has been a topic of intense debate, with critics arguing that it's unsustainable and contributes to climate change. However, the industry has been making strides in addressing these concerns. An increasing percentage of Bitcoin mining is now powered by renewable energy sources like solar, wind, and hydroelectric power. Additionally, the development of more energy-efficient mining hardware and the transition to proof-of-stake consensus mechanisms by other blockchains like Ethereum are helping to reduce the overall environmental footprint of the crypto industry. As we look ahead to the rest of 2026, there are several key events and milestones that could shape the trajectory of the crypto market. The Bitcoin halving, which occurs approximately every 4 years, is expected to take place in 2028, but the anticipation and speculation around this event often begin years in advance. Historically, Bitcoin halvings have been followed by significant bull runs, as the reduction in new supply creates upward pressure on prices. Additionally, the ongoing development of Ethereum 2.0 and the continued growth of Layer 2 scaling solutions like Arbitrum and Optimism will be critical for the long-term success of the Ethereum ecosystem. On the regulatory front, we're likely to see continued progress on the development of comprehensive crypto regulations in the US and other major jurisdictions. The passage of the Genius Act for stablecoins is just the beginning. We can expect to see similar efforts to create clear rules for other types of crypto assets, including NFTs, DeFi protocols, and tokenized securities. While regulation can sometimes be seen as a threat to the crypto industry, it's actually a necessary step towards mainstream adoption. Clear rules provide certainty for businesses and investors, and they help to weed out bad actors and protect consumers. In conclusion, the intersection of geopolitics, macroeconomics, and cryptocurrency is creating a complex and dynamic landscape for traders and investors. The trade wars, shifting alliances, and regulatory developments we're seeing today will have profound implications for the future of the global financial system. Bitcoin and other cryptocurrencies are emerging as important players in this new world order, offering an alternative to traditional fiat currencies and a hedge against economic uncertainty. However, navigating this landscape requires knowledge, discipline, and a willingness to adapt. By staying informed, managing your risk, and keeping a level head, you can position yourself to thrive in this exciting and rapidly evolving market. Thank you so much for joining me on this journey today. I hope this episode has given you valuable insights and actionable strategies for the week ahead. Remember, the crypto market never sleeps, and neither should your commitment to learning and improving as a trader. Keep your eyes on the charts, your finger on the pulse of global events, and your mind open to new possibilities. The future of finance is being written right now, and you have the opportunity to be a part of it. Until next time, this is Boni signing off. Stay curious, stay disciplined, and most importantly, stay profitable. And I'll see you on the other side.